Hello, I'm your host, Mike Gelb, and this is Consumer VC, where we discuss the intersection of venture capital and consumer innovation. If you're enjoying the show, please subscribe on YouTube or whichever platform that you're viewing this content. And if you want the full experience, subscribe to the newsletter at theconsumervc.com, where I send a weekly email of all the fundraising and product expansion news that's happening in the consumer space. You'll also get new episodes straight to your inbox. All content and episodes are for informational and entertainment purposes only and is not investment advice. Our guest today is Mathew Focht, who is the founding managing partner of Emerging. Emerging is a growth capital fund that's at the forefront of the technology-driven transformation in the restaurant and entertainment sector. Some of their investments include BatBox. BatBox is an entertainment concept that celebrates baseball by combining simulated gameplay with a high-energy sports bar. And they're also investors in F1 Arcade. F1 Arcade is a thrilling new simulation racing experience in the US, offering all the excitement, drama, and glamour of Formula One. We discuss how these sorts of deals, since this is really a first for consumer VC, the whole entertainment restaurant space and that combination, we discuss how these deals are constructed, how he thinks about what entertainment products work in restaurants and retail locations. Without further ado, here's Mathew. Mathew, thanks so much for joining me today. How are you?
Doing well. Thanks, Mike. Good to be with you.
Oh, thanks so much for coming on. Talk to me about how Emerging came together and why 2023 was the right time period to actually launch the fund.
So reason why we launched the fund is because of our operating companies. John Davey and I, we've been working together, partners for 2.5 decades. We co-founded a company called Consolidated Concepts, which is now part of Buyer's Edge platform. And we've today between Buyer's Edge platform and the real estate company Emerging Concepts, which I founded in 2012, we are the largest food and beverage network in the U.S. We're working with 1 out of 3 restaurants across the U.S., which gives us a huge edge when it comes to introducing technology to the space, reducing cost of customer acquisition, and introducing some of the latest things in technology that we see adding value to the operators out there, the CEOs and founders and truly early stage entrepreneurs out there. We have ability to deploy that technology a lot more cost effectively than is traditional, because it's a very fragmented, tough space to get in front of the owners. So there's that component in technology. And then we have a real estate component as well, that we're investing in tech-enabled concepts. And we have a company called Emerging Concepts that is building brand growth strategies using data science and really insights to how to build a concept brand in the U.S. So those two companies just has given us such an edge that at this point we knew we had to launch it. We were investing, we were taking minority investments. John and I personally were, and it just became a point that so many people asked us to join and be part of the investments with us that we need to step up and do this in a more significant fashion.
So I understand with your history and experience founding, Consolidated Concepts, and as well as having access in this network to restaurants across the country and of course different hospitality as well units, but and I understand from like a B2B perspective why it makes sense to invest as well in other technology that actually can help hospitality, because as well as you have a distribution advantage in that know a lot of these restaurants. Why does it also make sense though to also invest on the B2C side in real estate concepts?
Yeah. So with two things. I mean, when we with Emerging Concepts, which started in 2012, like I said, we started building a reputation of being a strategist or helping these concepts understand the prioritization of real estate across the country. It's a question. When you build a brand, you kind of don't know where you might be in one market, you might have one location, but where do you open the next market? Is it Miami? Is it LA? Is it Boston? Is it DC? And you have only limited assets, so limited capital. So you got to be very conscious of and prioritize that real estate and with those limited resources. So ultimately, what emerging concepts does extremely well is using data-backed strategy and understanding where do you want to open your next unit. And then once we identify that data strategy, then our team goes behind that strategy and starts executing it, finding those sites, and then ultimately negotiating terms, LOIs, and leases. So what happens is we get the chance to interact with these best in class of concepts and understand the management teams, understand the cash on cash returns they're getting because these landlords are writing big checks to offset the risk because they see how much value these concepts are bringing to their projects. So we have this ability to look underneath the hood for sometimes well over a year or two before we put capital to work. So ultimately, when Puttshack, for example, which is from the founders of Topgolf, they had a unit. We started working when they had one unit in the UK. They had one unit in London. They opened a couple other units. And then U.S. expansion. This is from, like I said, the founders of Topgolf, and they partnered with a couple of other guys, Adam Breeden, who we work with quite a bit right now. And they at that point, they're like, we want to expand across the U.S. So where do we expand? So our real estate company built that U.S. strategy, almost 3 years of strategy in front of them. And then we got Atlanta open, and we got Chicago open, and BlackRock at that point invested. Give them $130 million of debt with only 2 units open. And that comfort of lending that kind of money happened because there was a plan, a strategic plan that they could get behind, and they could see it was a data-backed strategy. And also, it didn't hurt that Puttshack was overperforming those first 2 units that opened in Boston and Chicago. Atlanta and Chicago were well overperforming the expectations, and they had a great management team as well. But that data strategy allowed them to access capital a little quicker than most because there was a real plan there.
So in terms of part of your expertise that you can also guide emerging concepts or entertainment concepts, right, is from the real estate side and really kind of understanding where actually build out into and actually how to scale those concepts around the country or however it makes sense to actually scale.
Exactly. And we get a chance to get to know the team and see that execution and all those return profiles that it's important to an investor before we put our capital to work. So we're not venture capital. We don't make 50 bets to win 2. And nothing wrong with venture capital. I know you got a lot of venture capital guests, but we're not private equity either, though. We're not taking majority buyout positions.
Great.
We're early stage growth equity. We come in, we're writing a check from usually $2 to $8 million, and sometimes we even start lower. And we build that. We use options to come in based on our ability to de-risk and perform for them as a partner, and leverage that position to get better terms later, or build to invest later near the initial valuation, based on our ability to help them grow and scale their company, which all takes advantage of our scalability as a partner. And we also get board positions when we're not usually the first or largest investor, or maybe the second or even the third largest investor. We get board positions because our strategic position. We're boards of 9 out of 14 investments now. And it's just because it's a position that we have because we see a lot. We've been in this space for 2.5 decades building brands.
So $2 to $8 million checks. What type of traction do you need to see from an entertainment concept in order for you all to be interested? How much data? How long have they been in business for? Typically?
Well, minimum 1 unit, but we like to come in 1 to 6 units. They really haven't screwed things up. Usually under 1 to 6. There's a little bit of a sweet spot you want to find. They have great brand equity. They have a great management team. They're highly profitable. Usually, stuff we're investing is 20% EBITDA margins or greater, especially the experiential entertainment stuff that we're investing in. They have a gaming aspect in that, all that gaming revenue or that piece of that business, like the Puttshack, and we just made a new investment called Pool House. That revenue is going to fly us all to the bottom line. So producing 20 to even 35% EBITDA margins in some situations So they look like more like software companies, in fact, than they do traditional food and beverage, which is around 10% for restaurants. So the profitability 2.5 times greater or more, and that we like to see 20% or more before we start really looking at them. And then we want to see white space analysis. What's the potential of the brand? And then it goes a little bit. Then we start peeling the onion a little bit further back of looking at what's the frequency, what's the reach, how big is the trade area, how large a trade area are people willing to drive from, and are they willing to offer? Can they get a premium for this experience and this entertainment experience? And then you get a little bit further, and you start looking at their execution on food and beverage and ops and such. But there's a lot of early stage components when it comes down to it. You're looking at about 4 main things: frequency, reach, the frequency, reach, premium, and check, and then ultimately the proprietary moat, or is there a tech moat or protection around this brand? Is it going to be easily duplicated? We all love Dave's Hot Chicken, but if Dave's Hot Chicken kills it, there's going to be another Dave's Hot Chicken next to him. Maybe not as good in the branding or marketing, but there'll be another chicken place right next to him. The stuff that we're investing in, there's a proprietary tech moat. You can't just open another one, and that's really important to us as well. We want to invest in companies that have technology incorporated in them that you just can't rip them off. It differentiates them.
What I find really interesting is the fund opened up in 2023, right? I think March 2023. Is that right?
Yeah.
And you're just coming off the back of COVID. So I'd imagine that I would think that some of these entertainment concepts were able to quite drive the number of consumers, or didn't actually have like a long history, just because they weren't actually able to service folks during the COVID period. How did you kind of analyze businesses through this period? I mean, I know it's still now because 2023 was only a year ago, but how did you assess or approach COVID as a relation to these entertainment concepts?
Well, I mean, we've been working with brands for, like I said, 2.5 decades. I mean, it used to be improv comedy club and theaters, and then it evolved a little bit more sophisticated to experiential and immersive. You heard those words in 2016. Started getting popular. And you look in a way back, it was bowling hours. It was Lucky Strikes. And now what do you see is Bolero.
Yeah.
And ultimately, those entertainment concepts hold up really, really well. There was a report by Solomon Partners that said entertainment concepts are close as you get to recession-proof in the consumer space. And a lot of that is because when you think about it, like restaurants and entertainment and consumers, like restaurants, they feel the pain. You stop spending money at restaurants when it downturn. If you look at 2008 to 2012, in fact, Bolero was only down 4% to 2008 to 2010. Very small, sudden, not very subtle drop for considering a recession. And the reason why they held up so strong is because people stopped taking those trips, maybe to overseas or down to the Caribbean, and they stayed local. And they still want to be entertained. And those dollars are being held in those local markets where those entertainment venues were. So what we saw in COVID, we saw the entertainment concepts coming out of the blocks even stronger. They were the first to come out. They came out ripping, If you look at Topgolf, have been around for 25 years, they were up literally over 30%, up to 50% in some of their venues coming out of COVID. And you think about it, why that is. Well, it's perfect. You had your bays, you had privacy, and you had food and beverage, and you had a little bit of a social experience. And a lot of these concepts that we invest in, they offer that social, really competitive social experience, or just a social experience in general, that you want to hang out, you want to be with your friends, and it's much more experiential than typical, like a Dave and Buster's. You're playing a game by yourself, and you may have one buddy or two people next to you. These are people up to 12 people per bay, or like Flight Club, the Dart concept, or F1. You have 4 racers. You're racing against your buddy, 4 wide. they're all built on social competitive entertainment or experiential stuff that you're doing as a group.
That makes a lot of sense, and certainly, I mean, I think about it as the movies, right? During that going to the movies is also recession proof because maybe you're not spending money to go on a cruise or to travel, but it's still
Yeah.
entertainment that you're actually going to, and it's a lot and it's a lot and of course it's a lot easier to get to,
Right.
um, and,
Right.
and and also a lot cheaper. But how do you evaluate kind of entertainment concepts as well as because I know the fund was started in 2023, but coming out of COVID, I understand that entertainment concepts were ripping. When you analyze companies where literally like it could be that for months for those few months it was zero 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 in revenue or very small revenue. Did you have to put like a pass on that because you knew
Yeah.
because of like the main event that was happening with COVID? How did you kind of like
Yeah.
analyze that
I
entire
got it. I
period
got it. Yeah.
altogether?
I see what you're saying. Yeah. I mean, it was actually good data even on those downturn in the markets. And we made 7 concept investments so far, and we have 14 total investments, half tech and half concepts. A lot of our stuff we invested in was just getting out of the blocks during COVID. So we didn't have a lot. Unfortunately, we don't have a lot of data tracking pre-COVID that I can tell you that okay, that these held up so much better than others in the average. But as a company, as our operating companies, we saw the data. We're working with literally 250,000 restaurants. If they have a food and beverage component, we're seeing the data. And on the entertainment side, we're integrated to a lot of these point of sale systems. We're looking at their frequency and reach, and we're studying them, making sure the day parts are strong, helps us do better real estate selection. So not as a fund, but as an operating companies, we saw the data during probably more than most of anybody in this space. But in the, end of the day, we always saw entertainment holding up better than most, and that gave us a conviction to come in this space. But so when you look at these concepts, they all got beat down on COVID. I mean, there's no exception. I mean,
Yeah.
but when you look at the performance of these, it's the EBITDA margins, the people, how quickly they came back. They perform better than casual dining. QSR did really well. Some of the better ones, the Chipotle's, and performed really well in these environments. But because they had a delivery business and that picked up a lot of that steam. But ultimately, entertainment was a darling of the space, and I don't think you had to have a wild imagination why.
For entertainment concepts, I'm just so curious because I think a lot of people have like definitions in terms of when COVID ended, for example. How long was it where entertainment concepts, like months or even it was months roughly, that actually they wouldn't be able to? There was no business there for like those few months.
I mean,
Was it
was
actually like quite quick or
no?
yeah?
It happened overnight, but I can tell you every state reacted so differently. So we were tracking every state and every major city even the states was different. So it was just a hodgepodge of reactions. And if you're in Texas or in Florida, you're like, well, not much changed. I mean,
Not much change. Got it.
But you're in Illinois, like nobody was on the street. I mean, I remember coming to the office and looking down the street, and I'm like, I'm the only one here, like in the city block, I think. So it really just depended. It really just depended on unfortunately, the politics became an important piece of the reaction, and then I don't think the response out of COVID was even as consistent as the shutdown. So I think everybody is just really geographically polarizing differences.
When you evaluate entertainment concepts, when I always think about entertainment, I think, or just anything that new maybe comes up. Is this something that's long lasting, or is it something that's not? Is it something that's going to that really could actually serve generations of people, or is it just something that maybe is more of like a flash in the pan, or and just serve just might be around for maybe 5-10 years, and then maybe get and then people uh, might not view it the same way. How do you evaluate entertainment concepts from like what you think is maybe like a fad, and not long lasting versus something that and maybe is still great IP, or I guess actually if it's a fad it probably isn't great IP, but in that it is technology, it is differentiated, but maybe you don't think it actually can reach widespread appeal versus something that actually is long lasting.
It's really a good question. We spent a lot on this, a lot of time on this, and in the day, you have to really dive deep into the concept and what value it's having for the market. And like those things I was talking about earlier, frequency and reach. There's nothing speaks better than frequency and reach. How often are you coming back? If you go to I don't know how many times you go to the museum. How many times you go to the art museum? Well, what's your frequency? How often are you going to the aquarium? How often are you going to if you go to a sporting event, how often are you going to that? So everything is a function of frequency and reach. There's really the variables, and then there's spend, there's dollars. How much are you spending on that? Are you getting a premium? That's what make up these concepts. And when you get a Top Golf doing like 1.5, and then you have loyalty members, and some experiential concepts we have are like 2 times a year, and that's considered a great experiential concept. You twice a year. The average customer comes twice a year. Great concept. If you're McDonald's, their top customers come like 50 times a year. So at the end of the day, what you really got to do, but they're not coming far. They're driving, 2 miles, 3 miles of McDonald's. So ultimately, but in the Top Golf and these concepts of Puttshack, they're coming 10, 15, 20, 30 miles away. So it's all that frequency reach. And you work in some of our really experiential stuff that's immersive and maybe a little bit more on the, let's just say on the stuff you're not going to have a higher frequency on, a little more artistic oriented versus data driven or experiential that you're going to bring your friends consistently over and over. You can see every quarter or so. Those concepts, you got to plan for it in the data. Like when we work on real estate strategy, we need to be on urban cores with high tourism because we know we're going to burn out the local market. So you got to count on enough of that transient person coming in that they're going to visit with their cans, and every time they come once a year, what's that annual visitors, and is that convenient? And if you look at each of these markets and each of these major cities, it was very clear in the data what concepts can be performing and where those tourists those high kind of the whatever you get a lot of transfer, you're getting a lot of travel, and tourism dollars actually make a big impact on these concepts. So those are things we're just studying, but each concept has their own formula, and some it doesn't matter. Like success and burnout is not likely as long as you're delivering a good experience. And in like a restaurant that is just delivering, how many of these diners that we know have not delivered a great experience, but they deliver good value and good hospitality. And in the day, if that's what you count on in a restaurant, they'll be around. And there's a lot of awesome restaurant groups like Let Us Entertain You that is one of the best operators in the country, in my opinion, that knows how to deliver, great product, consistency, and a good experience as well, but and their staff knows how to manage and take care of you. And ultimately that serving staff with that just the consistency of good quality food at not an obnoxious price, a pretty decent value, they can appeal to mass market. Same thing, every product, every concept we work with has their niche, but you can't, if you have a substandard experience, you're going to have a low frequency, you're going to go under 1, and then you're going to be burning out the market. Now, if that's your concept, that's the stuff we invest in. We stay away from that. But yeah.
How also do you think about entertainment concepts? Do they have to be their entirely own standalone, their own facility? Or do you also sell into, or can you also sell in like some of the entertainment concepts into restaurants and bars, for example?
Well, there's the FEC, kind of Family and Entertainment Center business. I just came from IAPA a couple of weeks ago in Orlando, and that's what this whole conference does is they sell entertainment within entertainment boxes. And there's a big business there. It's not what we focus in on. It's not the driver of our investments. However, some of the concepts that we invest in do offer ability to sell in other entertainment centers. There is a component like BatBox. It's like the top golf of baseball. We invest in that company this year. You have a cage. It's a modern version of a batting cage. You can adjust the ball speed. You can adjust you're getting a ball pitched to you. It looks like a pitcher. It's a digital, beautiful screen. The ball that's coming out looks like a pitcher throwing it at you. And technology knows when you're ready because you're in the stance. And recognizes that ball is going to, you're ready because it's based on your feet placed in the box. And then it pitches the ball to you from like 30 to up to equivalent to 90 miles per hour. You can adjust it. And nobody goes at 90, but you can do it. And so ultimately you've got this great experience that these batting cages, essentially the technology that are we're doing 6 to 8 of these, up to 10 of them in Dallas is the first one we're opening up, and is the first location. Then we're going to be announcing some more, but the initial 2 are Monterrey, Mexico. And the technology is from a South Korean company that we have North American exclusive on, a company called Strike Zone that produced the first golf it's a leader golf simulator company called Strike Zone. They have 40,000 simulators around the world. And, but anyways, those boxes for the baseball simulators were at IAPA. They thought they were going to sell $1 million or $2. They end up selling 3-4 times that as much because these family entertainment centers want these standalone experiences as well. But we're very, very careful when we do sell those entertainment boxes or these simulators, where they go. Because we don't want them to cannibalize the brand. If we do a standalone flagship locations, we do not want an FEC or family entertainment center around the corner. They need to be completely different trade areas, and then we can find it as a complement.
No, that makes a lot of sense. And I imagine that's kind of can be tricky at times, figuring out what actually makes sense, where it makes sense, whether you actually selling into a restaurant or a different spot, and making sure that doesn't cannibalize your own standalone. When you invest in a company, when you're writing that $2 million to $8 million check, and they currently have 1 to 6 units. What usually is the plan? I imagine this varies with all your companies, but when it comes to growth expansion and actually growing those units into more areas and kind of around the country, what usually is that pace that actually makes sense?
I would say, the pace makes sense as long as it's sustainable in sales and operations. In the beginning, you find these companies that go slow to go fast are much better positioned. Then a lot of times you see private equity or capital gets infused and they just go nuts. They go hog wild.
When you're investing, are these companies, do they tend to be EBITDA positive? Are they tend to be like cash flow positive or not?
Yeah. All the companies that we invest in are extremely profitable at the unit level. And they're usually making money day one. Like they're profitable, high margin day one. Nobody's writing a check to fund losses. However, you got corporate G&A, which is the general administrative, the team, the office. You got to start building infrastructure to support the growth of the company, right? So you got a president, you might have a CMO, you might have a COO, you might start layering up, you might have an inside architect, you got to start building infrastructure for growth and scale. So that G&A brings down the obviously corporate EBITDA. You may not be profitable for 2-3 years because at the unit level, you're extremely profitable, but you're building this infrastructure up to help you scale. And so what you got to do is you got to balance that act. You got to make sure your G&A is not too overwhelming, and it has to look good to your LPs, your investors. But at the same time, you got to build a deep enough bench that you can support the growth, and not put too much heavy pressure on the team, or because you won't have sustainable comp increases, or just to get the units open and perform at a consistent average unit volume and EBITDA margin. So there's a lot. It's an artwork. There's an art of building up your team in those early units so you can recruit and scale sustainably, with usually going 1 to 6 we invest in, but we see a lot of guys that go, let's say 1 to 6, 2 or 3. They open 2 units the next year, then they open 3 to 4 units the next year, and then they get to like 4 to 8. That's what we see. Now, once you get beyond that, when you start opening one a month of these concepts that we work with, that's a heavy load on the team. That's just a lot of pressure. And some of the concepts we work with do it, but these are not QSR concepts. Like if you're talking Chipotle's in 2,500 square foot or a franchise concept, you're ripping and roaring. You could open 3 a day. But these concepts that we focus in on are they're 3 to 5 times bigger on average, and they're just more and more complex.
Got it. That makes sense. How do you think about as well the return profile of concepts versus technology for restaurants? Because I imagine that the technology for the technology that's kind of the underpinnings for restaurants, those are kind of pure software companies. So I imagine like the margin profiles are pretty high, whereas these concepts are a bit more complex, right? Because you obviously have the real estate component, you have the physical, the physical product component. So how do you think about, from a return profile, managing these 2 buckets?
Well, our strategy, we have 2 different types of strategies. And in the technology, we often find ourselves writing a smaller check in the earlier stages. And then giving ourselves the optionality based on performance. So we'll start off with a smaller check, and then we'll give ourselves greater optionality to, we might come in with $1 million check and give ourselves another $7 million over the next 2 years based on hitting these performance goals of contributing to their success or their growth. That works really well for us. And versus a concept, it's heavy asset. You can't do that. You can't put capital little by little. You have a huge asset expenditure, so you just got to sink that money into them. But again, we don't do that without relationships. So before we put our capital work, concept or tech, we're taking them to the market. We're introducing them to the ideal customer profiles of this technology, because we work with a third of the U.S. market. We know where their tech should fit. If we're getting positive feedback and we see growth organically, and they're piloting and they give us good feedback, then we put our capital work if we think it has a potential. Same thing on the concept side. We're taking them to market. We're reducing that site acquisition cost. We have a very targeted site acquisition or site selection process, and we invest when we see great penetration. So we're in a good plan. So both these situations, we're early. We come in early, but the go to market with technology is usually fewer dollars, and putting that money in as you see more momentum, versus asset heavy. You're going all in pretty much, and bigger bets. But we'll still do a bridge round. We'll still like to put more capital work. We also produce, Mike, about 50 to 100 million of co-investment opportunities outside of our core investment. So we may only put 2 to 8 million, or hopefully we're putting $8 million in investment, but that concept will have opportunities for investment that could be another 20 million above that. So we bring those our LPs, our investors, and our relationships opportunities to invest directly into the company, in addition to what we're doing as a fund.
For entertainment concepts, because you are managing so much, you obviously have the technology piece, which is that IP and as well as the differentiator. You also as well have the real estate piece. You also you have you have these own units, and as well as you have several units or expanding to several units. What typically can go wrong when it comes to the entertainment concepts?
I mean,
Typically, might not be the best word,
yeah,
but
yeah. I mean, yeah. I mean, yeah. I would probably wouldn't like to see use the word typical, but I would say, what are those things that can go wrong that I see that are common, and I would say, the expectation of going of tremendous growth in the early years. A lot of these concepts underestimate the time and energy to get a site open, and from the permits to the construction. We did one of our concepts, great space, get in the space, and then the walls aren't sturdy enough to support the project. So they got to literally rebuild the walls. You never could anticipate that, but that's going to cost 6 months. There's always something, usually on the construction variation, when you're early in building a brand. There's a fixture. You don't have systems in place. There's delays in your plans because you haven't massaged your construction documents well enough to know what's value engineered and what's going to be extremely expensive, and even the supply chain of providing that, sometimes that equipment takes you longer. So the early years of growth are often underestimated, and by a factor of 2. So they say they're going to get open a year and a half. I would say 3 years. If they said they're going to open in a year, I'd say 2 years. That is just the reality of it. You can't. You got to be a lot more conservative. The other side of it is, I say, again, common things. Is that they open, and the COGS, the cost of goods, the expense of labor is a lot higher than they realize. They don't have it dialed in for a while, and it's a good thing. They shouldn't have it dialed in perfect, but they overhire, and they spend too much money on their food, and their everything. They don't look as profitable as they should, and then when they're trying to do a capital raise right behind it, it's tough. It's a little tougher because they're not as dialed in as they could be. And then that is not it's not necessarily the wrong way to do things. It's just, the reality is, you got to plan on it. You got to give your team enough time to dial in those numbers, not to have unreasonable expectations. And that's all we're talking about here, is setting reasonable expectations on everybody in the team, so they're not stressed out on of growing the business as much as they're stressed out of providing a good customer experience.
how also long is the fund cycle in terms of it and also what is the goal from like a returns from a return perspective for the concepts?
Yeah, I mean, the first thing that we did, John and I seeded the fund, and the GP seeded the fund with a $30 million investment of our own money. And then we went out and we got 50. We went, who's our friends and family or people in the industry that we've had great success with, that they've been supportive of us, and we've been able to be supportive of their career and their success of their companies. We went and we reached out to them and got them part of the fund. We have 50 CEOs and founders. I'm going to unfortunately have to break that at some point, but we got 50 today, CEOs and founders in the fund. And then the next chapter is for us to bring in as a co-anchor. That's what we're working on right now. We got a bunch of groups in diligence as a co-anchor in the fund. Those they take advantage of our minority positions and potentially could be a majority owner in these companies in our later rounds. They also can take advantage of our co-investments. So that's what we're focused on into Q1. In terms of our strategy, this is a 10-year fund where we expect to see realizations and distributions starting by year 5. We'll see it early. I think we'll see it earlier. We have some companies already slated for IPO. already talking IPO. I shouldn't say really slated. The documents aren't in, but they have some documentation of plans with going IPO. And then we've got we've got a handful of companies that are on that same path, and then we have a balance our strategic purchases. So ultimately, this fund could go 10 years, and we could extend it to. I mean, you would have companies in the portfolio that could go 2 more years if the GP committee decides to hold them for the best interest of the investor base. But the goal is to get realizations or distribution, and and years by year 5, start seeing that. In terms of the goal, our goal is to return a 4x return, Mike, or a 35% IRR. So that would make us in the top 10 percentile of funds. That's our internal goal and our objective. We share that with our LPs. They know that. It's not a secret. It's pretty high goal, and I think we're well on that track to do that. We have 14 investments right now in the portfolio. We'll probably only have 17 in Fund 1. So somebody coming in the fund right now is getting an amazing visibility into what this fund looks like, and can see an incredible portfolio that we've been able to put together. So Fund 1s and Fund 2s usually outperform, you can see historically, other funds and sequential funds. Mm-hmm. And I hopefully that's not the case for us. I don't think we're going to have, I think a lot of concepts a lot of funds have strategy drift, which they come in early and they start with their small fund, and all of a sudden I talk to, I hear or I see that they went from Fund 1 to Fund 5, and they're now 10 times bigger. They went from 100 million to $2 billion fund. And I'm like, well, how is their strategy relevant? So you started with, so we are focused on strategy. We know what we're good at. We have the name emerging for a reason. And we're going to stay small, nimble, and produce high alpha opportunities leveraging our operating companies and our relationships.
So the goal from that standpoint is always to stay around 100 million, let's say, fund for all the funds that you raised.
I think we got to be under 300 million or less. And I think
300 million. Okay.
I think we can be 300 million or less for growth, early stage growth capital. You can write that $2 to $15 million check. When you get a little bit bigger, you can write a $15 million check. But ultimately, that we don't have any plans to for this stage of growth. Now, if there's an down the road, there's always thoughts of doing buyout with another partner in these companies. That's why we're looking for a great co-anchor for our Fund 1, because we want to lead to somebody to majority investments. But as emerging, we will always have a fund dedicated to this stage.
Matthew, we're going to do a really quick fire round. How does that sound?
Deal. Let's do it.
I'm going to say a short sentence or question, and then you can give me a quick response. What's a belief you hold that you think is most contrarian from others?
Geez, there's supposed to be a fire round.
I know. Sorry.
Most contrarian. I think probably the long-term hold. I think everybody likes to think about long-term hold in this space, but it is the better thing. I don't think so.
What's your favorite consumer product innovation within the last 10 years? And that could be very, very broad.
Consumer product innovation. I tell you one I'm really excited about right now is investment we just made in called Pool House from the founders of Topgolf. I don't know if it's my favorite yet because we don't have enough experience with it, but I tell you it's going to transform the game of pool, and it allows anybody that offers an amateur to play the game of pool who's never played a game of pool to compete with a pool shark. So using technology to broaden the moat, I think is probably the best thing that's happened to our space. And I've seen that happen with Topgolf initially 25 years ago. 60% of people had never been on a golf course to what we're investing in Pool House today.
What do you think you're best at, and what do you think you most have to learn?
I think what I'm best at personally is identifying companies that we can scale, leveraging what we know, not getting over our skis, and staying relative to a value add player versus just where we see good investment opportunity. So focus on things that we can actually impact and de-risk, and ultimately be the driver of the business. I mean, what I most learned, I mean, we're in fund one. I feel extremely naive in fund one. I thought this was going to be, a lot quicker to raise money. I thought I had the fun. I think what we do is so exceptional, and obviously I'm high on my own supply. But ultimately, I was extremely naive to think how quickly the process is to get a fund one off the ground and to complete a fundraise.
I know you launched it in 2023. How long did it take to actually fundraise for Fund Run?
We're closing in we're going to be closing in Q1 next year. So it's
okay, cool.
So we got to, but at the end of the day, you start talking to what you're going to do. We do this annual boat cruise, and one of our GPs, John Davies' boat, and he's the GP. He's got a nice sized boat, and we get to 30 people on the boat. And I remember when we first started it, I was like, guys, we're gonna raise the fund. We're actually gonna do this. I think it's gonna work out great. And now, we're 2 years later. We just had it in November, and I'm like, holy cow, we're 14 investments in, and you guys are rock stars, and look who's here. And there was a couple of people that were with us in the beginning on that trip. And it's it's an unbelievable feeling to know that, we've been able to execute at some point of getting this tremendous group of CEOs and founders together, 50 of them, and now 14 investments that are performing really well. So, it takes a long time, man. It was definitely eye-opening for me. And our LP base are not professional investors for the most part. These guys are seasoned. They're CEOs and founders. They're guys that have built their own companies, and they're like, "Why do you want me to invest in the fund? I don't invest in anybody besides what I do." And that's a lot of those conversations were so understanding that they understood now the value of they understood the value quickly of us coming together, investing in entrepreneurs and CEOs, and they want to be part of it. They have a big piece of this, of why we're successful where we are today.
Cool. No, that's amazing. And also just having that group of LP too, in that they've actually built businesses themselves and also can help advise as well. Your companies. I mean, that's incredible. Final question. What's one book that's inspired you personally and one book that's inspired you professionally?
There's a book called The Psychology of Money that was interesting to me. It kind of did exactly what I did not expect it to do. And the common themes, the way I thought, and how you're driven, and how different people are driven with money. It was a great book, I think, personally for me, and the Psychology of Money. Professionally, these EOS books I read years ago. I digested them like I was eating dinner in one sitting. I think understanding how to build, an operating system for your company is really important. You got to maintain flexibility. You also got to be vulnerable. And I think one of the key factors, a book I read called Leading with Vulnerability recently. I read it a month ago, I think, and it's a great book about being just vulnerable with your team and being vulnerable with, you're professionally, to the point that, people can give you real feedback, and that's tough to take. Those two.
Cool. No, that's great. That's great. Thanks so much for these, Leading with Vulnerability and Psychology of Money. This is fantastic. Mathew, thank you. Thank you so much for your time. This was a lot of fun. Thank you.
Thanks, Mike. Enjoyed it.
And there you have it. It was a pleasure chatting with Mathew. Mathew, thanks again so much for coming on the podcast. Really appreciate it. If you enjoy this show, please subscribe to the newsletter at theconsumervc.com, where I share weekly deals of all the fundraisers that happen in the wonderful world of consumer, as well as all the podcast episodes once they drop. Thanks for listening.